All right. All right. Wonderful to see everyone. It is a beautiful weekend here in Southern California, so uh, I appreciate you being with us and taking your special time of your day and to be with us. And hopefully, you will find this educational and informative, especially after the week we had. So this week, what I like to do is always I like to look at where the economy stands and some of my input and the thoughts that I have in regards to economy. And then we'll review uh, where the markets were and see what direction they might be heading. I also put this in there for the people who follow me as far as, some of the things that I do, some of the strategies I do. And I want to share how the markets, they leave clues. So they give us a little edge and allow us to read them a little better so we could have the odds in our favor. As always, we will have the trade of the week or trades of the week. I will introduce a new ETF, ETN of the week, which has been pretty popular and good indicator. And then we started last week uh, to see where the expected move in the S&P would be in our short uh, week coming up, which is going to have the 4-day week because of the 4th of July weekend. Before starting our analysis of the markets and the economy, this was important to me. Some of you who are old enough to remember that Eminem had a hit song in the year 2000 called Stan or Stanley. And the story was about this fanatic fan of his that he was following on every day, was writing letters to him, and the story ends that it's tragic ending to that song is when Stanley, with his girlfriend, pregnant girlfriend, in the trunk of the car, he runs the car into the river and they all die. And there was this miscommunication. I mean, Eminem was actually at that moment, he was writing him a letter, or he heard the story, and he was getting the mails, and basically this tragedy would have been completely avoided. But that's how the miscommunication ends in tragedies and misunderstandings. Um, Most of you might have heard about this young 20-year-old um, and that who apparently committed suicide by jumping in front of the train. He was one of those Robin Hood new traders, and he was apparently doing a lot of vertical spreads, thinking that uh, my risk is limited. He had read probably a little bit, but he didn't really know the ins and outs of not only just the strategy itself, but the logistics behind it. He didn't really, apparently hadn't done many trades. So sometimes the cloud of not understanding creates this misunderstandings. In this case, it was really a tragedy that would have been avoided completely. Because apparently what happened, Robin Hood, I'm assuming he had a put spread on a vertical put spread on one of the large technology companies. And when the Friday had come, probably he saw that, thinking that, okay, my um, buy or the lower put side will cover my sales leg of the trade. And then he receives this negative $730,000 balance, thinking that he owes that money. Obviously, the broker was not clear, and they've come and they said they will make some changes, in this case, Robinhood. But you will see a lot more of these. And the whole purpose, again, in the last few months when we started these training sessions, was to avoid misunderstandings and learning in depth rather than the shallow understandings of the markets or the strategies. The goal is we want to make sure we know how uh, every strategy works in depth. What are the reasons we get in? And that's one of the reasons I'm a very big advocate of having journals. When you do the trade, I immediately, if you've seen, I do put my limits in there. I know my targets, and I'm in, and I make sure that I'm out of my trades, if not a day or 2 days before the expiration, definitely on that day. And in this case, there won't be any misunderstanding and mishaps. In this young man's case, I mean, he didn't really owe 730,000. The worst case would have been that on Monday, the broker would have covered this, and he probably would have had maybe the most $6,000 or $7,000 of loss. But he didn't understand how everything worked, and that's that's really a tragedy. Tragedy. So that's what we're trying to do with our gatherings on Saturdays, to avoid those and make sure that we understand exactly where we stand and what kind of a strategy that we are using is we do have a defined plan, why we got in, what instrument we use, what are our targets, and when we will get out, which is the most important thing. With that in mind, let's review the economy. That, as you know, last week there was a couple of things happened. Number one, the case for the coronavirus, apparently it's in the southern states are coming back, they're increasing, while New York, New Jersey, and Connecticut, they feel that they have it more under control. But then you see places like Texas, and especially Houston, and then Florida, Arizona, even Southern California, from LA to Riverside, they have been increasing cases. Perhaps one of the reasons is more people are getting tested. But anyway, it has a psychological effect. The second thing was on Thursday, the Fed, they did their stress test of the banks, which are about 34 of them, to find out can they handle all the stress that they started in 2008, 2009, to make sure that big banks and they can handle the impact of, in this case, the corona health effect. And well, the thing was not just the finding, the thing was the Fed's reaction. And we will have more ideas this coming Wednesday to see what really has happened, because they came and they said, by third quarter, in the third quarter, probably around September, the banks are not allowed to increase their dividends. They're not allowed to have buybacks. And the question was not just what they said, because there was expectation. The question was, they were very strong, and problem was, what did they know? And do they have something that the markets don't know? And this thing happened, if you recall, the first week of March, when the Fed came and immediately dropped at the full point. Well, there was a thought of quarter or half. I remember one of our first classes, we were looking at the Fed's futures as far as what are the chances in the next Fed meeting that the markets will see a drop of 1 basis point, and the Fed did it immediately. So the markets took that, if you recall, that's when the really volatility started, with the markets having this long ranges of movements, mostly obviously to the downside. So that's what the market, I think, overreacted on Friday. That in mind, obviously there's this understanding that we are in a recession, and I just thought it's really good to just go back, according to the National Business Bureau of Economics, NBER, is what they talk about. A recession is a significant decline in economic activity spread across the economy, and it is normally visible in production, employment, and other indicators. And recession begins when the economy reaches a peak of economic activity and ends, which is a trough of the market or the cycle. the question is, this time, and I'm a student of history, as you know, things are, I think, we are in a different world right now. And this is the reason. This study was done, and historically, when we look at the recessions, we look at there's a shock, which we had in 2008, we had the financial shock, and then we've had, obviously, in the 2000, we had the internet bubble technology shock, and then after that, we had the 9/11. Usually what happens, the business contracts, and then the unemployment affects the unemployment, and at the end it's the consumption, which is the consumers, as you know, they're like a 70% of part of GDP, and we really need that consumption. This time with the Corona recession, we do have the shock. The major difference is that the collapse of services, which affects the business contraction, the huge unemployments, and the huge consumption loss. The things that this makes us different than the other recessions. And if we go back the last 200 years, and we've done studies and we found out, granted, the recessions happen and it follows a normal cycles, but in the past, it has been, the majority of time, it's been in the manufacturing. And the manufacturing affects then the services, but the services have continued. I mean, in 2008, people still would go out and eat. They would do some of the things that absolutely they have stopped doing it. And what happens without the face-to-face activities, a lot of small businesses obviously will go out of business. And this is the major difference. And we still haven't seen the full effect of this collapse of the services. Now, we have about 47 million people unemployed right now, which is a huge number. Some of them are going back to work. Till we have the consumers having the confidence, and this has started before the government mandated closures, that the consumers had already slowed down. And I remember even when we started our group here, we started face to face. We had, we would sit down in the conference room, and then before even the government asked, we had decided maybe it's better if we do the Zoom call. So the consumer had already made up its mind that they're not going to go out as much as they were before the government mandated. One of the interesting things that the question comes, and it affects the markets actually, and we do hear, as far as, when you watch the business news, that the amount of money, this is on the sideline with the liquidity. I mean, we compare it to January 20, and you look at this, there's about $15.4 trillion of bank deposits. Now, that's a huge amount. And that gives an indication that, well, these are on the sideline and maybe they will go back to the market. But what are they there? And one of the studies that was done, but when looking at the consumers, which as I mentioned, the consumer spending is the engine of the economic growth, and basically that will bring us out of recession. And when they did this study, they looked at the behavior of the consumption or spending money had not changed much. And then we go back to the zip codes where the level of income is in the lower 25%. And you can see the lower 25%, they are down only 7%, 6%. And when you go to the top 25% in the affluent neighborhoods, that's where the biggest hit has happened. It's at 20%. Now, we are looking at the beauty shops, we look at the high-end restaurants, you look at a massage and physical care, even the leisure, the hotels. So basically the consumers that they have the largest amount of money, they are not really spending, and they have parked their car because they don't have the confidence yet. On the other hand, the lower end of the market, which are last week when we looked at the average income per hour, and we noticed about 30 to 40% of the uh, uh, wage earners, they're actually doing better on with unemployment paychecks than they were doing on their own. So they're the ones who have that discretionary funds, and they have been spending. So the question is, when the top 25 or the top 50 basically percent gonna come back and start consuming? Now, what is happening is, you can see, it's this, I mentioned again, the biggest effect has been in the neighborhood of the top 25%. And I mentioned again the high-end restaurants, the barber shops, beauty shops, the pedicure, manicure, the facial, all of those have been affected. Just our tradition, we're looking at the first trust advisors and Department of Labor to see what is happening. We are nowhere close to, especially look at the TSA. People are started flying. If I look at the week over week and month over month, but there's still huge challenge. And then the same thing with the hotels. So this is more of a reference point, so you can study it on your own. But it is still alarming to see that it's going to take quite some time. According to Fed, it might be years before we get back to the real norm. With that in mind, let's review what happened in the markets. It was, on the surface, doesn't look a lot happened, because if you look at week over week, but day over day, if you look at it, we've had amazing wide movements. So week over week, the Dow Jones Industrial was down 3.31%, S&P was down 2.86%, NASDAQ, being the strongest sector, was down 1.9%, and then this is from Barron's 400 that they choose, they were down 3.52%. The common theme was everything was down, and from utilities to transportation, industrial had the biggest hit, the New York Composite. So S&P, everything was down. But on the other hand, you can see that gold was, get my pointer. So you can see gold was actually up for the week, and crude oil was a little down. And the bond market, which we emphasize a lot, they were up. So that was the flight to safety again. On the other hand, dollar was pretty much flat. As far as the sentiment, we still, as of last week, we still in the euphoria. We've come down a little bit, but we're still at the 51.51. So let's look at some of the charts of the markets that we had. I like to look at the futures because the futures are the inflow. This is, again, this is from the TradeStation, but you have access, if you have a Thinkorswim, to the Ameritrade, you have access through Finviz. I like to study the futures. Don't have to trade futures, but they are the guiding, and they're the guideposts of the inflows, and the markets do flow, the cash markets flow follows the futures. So that's why it's very important. If you're doing analysis, I'd rather do it with the futures market, and especially, again, they're almost open a little under 23 hours a day. Last week we studied the Bollinger Band, so I thought we will have the common theme and see how I look at the markets and where we stood using the Bollinger Bands. And in the futures, as I mentioned, I'd like to use the 18-day or 18-bar moving average. Now this is with the S&P mini S&Ps. The 18-day flattened, we broke under, and what has happened, that's when we broke under, then the selling pressure, it accelerated. And so by looking at this, as you can see, our 100-day moving average is our next real big support. But the first support will be the lower end of Bollinger Band. As you know, Bollinger Bands gives you the boundaries, and what happens is it allows you to have the indication of where the resistance will be, where will be the as far as the support. So in reality, this is what you can see. We are flattening as the moving average is flattened. We are actually flattening in our band. Um, One other thing is it's been a big support is that round number, the 3,000. So we are very close, and that's what we will be watching. 29, 80, 85 is a big next target. Our stochastics gave us a little heads up. We were embedded, which is fine. We can be up here and still be positive, and there's no reason to sell. But the minute we cross the 0.8, then we become overbought. And then when we go below 0.5, that's selling pressure. So basically, that's where we want to make sure be a little cautious. But there was a lot of, I mentioned there was a lot of damage done with this bar the day after the Fed meeting. And that's when I felt psychologically something is happening. So, but our biggest leaders are in our NASDAQ. And I had mentioned it, that the five horsemen, when you have the Apple and you have the Amazons of the world and the Google and Facebook and Microsoft. And as you can see, we still, this is on the weekly. I look at the weekly. We still is strong. I will talk about these bars. So they've been some selling pressure, but we are far away from our averages. Now, what happens? This is on the weekly. What happens? We are embedded, but the minute, usually when you go, stochastics go below, as I mentioned, 80 becomes overbought. If that crosses, the markets like to go and kiss their 18-day moving average. A couple of things also happened this week because the 10,000 number is the round numbers. The markets like those round numbers. So, and there's always either big resistance or support around that. And we went over it last week and then we came down. So we'll see if the selling will continue. And with that in mind, we can look at the weekly part of the daily part of the NASDAQ. And as you can see, we are right around that 18 days moving average. We crossed it.
Hey, Ramin.
Yes.
I can't hear you anymore.
Oh, how about now?
Can anybody else? Can everybody else hear Ramin?
Sean?
I can hear normally. I don't have an issue here.
Anyone else? Sean, can you?
I can hear you, Ramin.
Oh, okay. Martin, you want to try the audio? Sean, maybe you can talk and see.
Yep, I don't know.
Okay.
I mean, basically, everybody can just unmute and talk if you have an issue, but I don't have an issue here.
Okay, maybe you can send a message to Martin.
Okay.
Because he can't hear me, obviously. So.
Ramin, okay. Can I suggest to set up your screen that we can see the whole your face?
Oh, you can see me, or?
It's half of your head. Just bring it a little, push it back a little bit. Oh, yes.
Okay, so I don't see myself, so I don't. I minimize. I like to concentrate on the charts. I don't like to look at my face while I'm talking. So
your wife likes looking at your face.
I guess so. I'm loved. So.
I'm a photographer. Don't forget that. I watch all the frames.
All right. Thank you. All right. If you're good, we'll continue. So as you can see, the NASDAQ is in a crucial point right now. We're still on the support, but we just went to oversold. So this is what we will watch for next week. It's very important. one thing with the bands, usually again, when we hit the lower band or upper band, the markets like to rebound from them. Historically, also, when we go to these lower bands, the option sellers, the put writers, they like to come and protect that, and they start selling. So this is just a hint. When the market goes to the lower band, the option sellers like to, these are more of an institutional, to support the market. So we'll see what happens. As far as the biggest thing is the 10-year note. 10-year note, this is Russell, sorry. The Russell 2000 has been really Achilles' heels, had a great run because of there's a lot of energy stocks, a lot of economic sensitive banking. They were part of this index, and they had a great move. You could see we hit the upper band of the Bollinger Band, came back to our support at 100-day. We went up at the top band, we came down, we kissed that 100-day, we bounced again, went over the 18-day, and now we've had this sell-off. So most likely, as you can see, the lower band and also the 100-day, they're coming together. So that could present a good support, but they are weak. Basically, because a bigger part of them is the financial and energy, with energy being down almost 39% still year to date, and financial being down 27% after all the moves that they had, you can see why there's a weakness. Now, this is the Dow Jones. You see, it's the weakest. Again, they have a lot of economic sensitive. So whenever you have this concern about the coronavirus or the banking, that's they get hit the hardest. We also mentioned they are very much price oriented market as far as the indexes go. So the big stocks, when they get hit, they affected Dow Jones much more. So this index, and as you can see, we could not stay above the 18 days. We basically broke down. We are close to the lower band and very close to the 18-day, and we are oversold at this time. Now, the 10-year, on the other hand, this is the weekly. We did have 2 weeks ago when we had this wonderful move in the markets, the 10-year was selling off. There was a concern about the rates. If you recall, we actually, the 10-year notes went to 0.96. And then immediately the Fed came back and they pushed it down, and we went down to 0.65, around that area. But again, these are 18 weeks, you can see they play a support. Now, there's arguments about the technical analysis and the technical indicators, whether it's a self-fulfilling prophecy or not. It's up to you, but I've done this for 30 plus years, and there is, again, this human psychology, it's the supply and demand, and they dictate, and you can see why these, let's say these moving averages, they do play a role. Whether everybody, because they follow it, whatever it is, it gives me, again, that edge to be prepared. For instance, when it came here, I didn't have any confirmation of breaking down. That's when the risk was off, and that's where you could see if the bonds are going up, that could affect the stock market. This is on a daily basis. We are flattening, but we are holding above the 18 days. Opposite story of, for instance, Dow Jones and also with the Russell 2000. Gold, I think we followed gold for quite some time, and I think it does play a role. I believe last week there was a question about the inflation and how the gold is going to play a role. The gold is becoming the go-to insurance, and we are seeing that the bands are narrowing. We have been in this box since really February, believe it or not, but like mid-March, we've been just going up and down. We are very close to the upper channel, So there might be some resistance there, but gold is not giving up. Gold is, I believe, still going to be, it should be a part of your portfolio. I probably would prefer to add more to my position when we hit the 18-day moving average. But right now, basically just by looking at these bars, there is the buying pressure has come in. We did break above this moving the Bollinger Band. So obviously, naturally, you wanted to come inside the band, but there's a lot of strength right now. This is something that's important to understand, that asset allocation is important. The other thing is, I believe, I'd mentioned it before, we've had a class on the Bitcoin, and
I mean,
that's
we
why.
have some noise in the background. Is that
Oh,
from your side?
could you hold on? Could
Okay.
you just pause me? I'll
Okay.
just 1 second. Let me see if I can. Sorry about that. So the Bitcoin, as you can see, the band is really narrowing right now. So we're on the lower edge of the band. So that what it shows us, that the volatility has gone down, but something could big happening in the future. So now that the volume is lower, basically, not the volume, but the band, the volatility is lower, we can assume that there's some accumulation or something is going to happen. So with that in mind, I've mentioned last week, Apple is the key. Apple is the biggest part of all the indexes that we talked about. And basically what has happened with this is, I thought combining Apple's pricing, but also the Fibonacci retracement, and how we can use these indicators like Fibonacci to project the future. So we've learned about the retracement. I had mentioned about the ambush zone, which is the 50 to 61.8%. But we could also look at the projection of what will happen at 123.6, 138.2. We can actually go 161.8, go to 200. And you can see these attractions. I mean, we did pass that when we went back and went over the high of where we were in, let's say, February. We broke out. We hit that 123.6, sold up, came to that 100, tried again. We broke above that, went to 130.8, 138.2, and then we came back to 123.6. If you want to see what the markets are going to do, that's what I would follow Apple. Right now, Apple had obviously a couple of stories again about closing some of the stores, and I also watched the volume. So we had some distribution day on Friday. One of the things about NASDAQ, as you know, one of the reasons NASDAQ had a big hit was the Facebook news came out, and they really, there was a big distribution in Facebook. The next one is Amazon. Amazon, I've said it before, it's its own world. And I think whether there's COVID or not, I mean, this COVID actually helped Amazon's top line unbelievably. So what has happened, again, the same strategy with the Fibonacci, you can see we actually at the 200%. Now we have really got the resistance. The reason I share this, not only to see the price of Amazon, but this is what you could do with Fibonacci's. You can actually do there's an extension you can use. You can do the time Fibonacci's, but you also don't have to use the retracement limited at 100. With stronger stocks, I could do the same thing with the Zoom technology. We can do the same thing, or the Zoom video. We can do the same thing with Shopify, Zscaler. You can actually do the projections to see where the future will bring and where are the resistance and where's the attractions. So again, for the NASDAQ, we want to watch what is happening with Apple. We want to watch what is happening with Amazon. And with technology, if it breaks down, it's most likely going to affect the whole market. So it's not just going to be the sector rotation, it could be even bigger news. So just watch that. I end this with we've had this confusion why we have these two stories. You have the stock market and you have the street, or they just don't gel. The economy tells us a different story and the stock market is giving us another story. So this is what is happening. I had mentioned again before with the hope, there's a lot of, we are a positive, as a human beings, we want to be positive, and we are looking at the glass half full right now. So in this situation, the bulls have, not only because of the liquidity of the Fed injected, but some of the individual retailer investors and some of the other hedge fund investors, what the market is taking into account is the three things. First of all, they feel that the COVID-19 crisis will be over, probably by third or fourth quarter, and everything will go back to normal. The second assumption is that we are, the Federal Reserve got our back. If it's good, then they will take the foot out of the brake. If it's bad, then they will back us up and they put foot on the gas pedal. So they make sure that there is going to be asset growth. The third one is that even if the assets, the stock market appears overvalued because of, we haven't seen the true effect of the earnings, and they will be positive, and they look at the third and fourth quarter. So you can argue against every one of these. So, but I'm saying these are the best case scenario. So I leave it up to you to make your own analysis whether any of these hold. So I've said it before, you want to be, have your own scenario, have your anticipation, do participate, but you always have to have your risk management in place. The minute that you feel euphoric and you feel invincible, that's the time you got to be out of the market. Nothing can go wrong, doing fantastic. So this is, there are wonderful times ahead. I think the volatility is here to stay with us. So volatility could be your enemy or could be your friend. Use it as a friend. Learn as much as you can about it. And as far as the markets, these are actually exciting times. This one I thought I'll do it individually. I mentioned about markets leave clues. And the reason I said that, I was looking at the markets. This is as of, it was about Monday. And I'm looking at that. And I've talked about these, we call them tails or wicks. Not these wicks, what it means is the market, if you recall from studies of candlesticks, when it's green, that means the market opened here. It closed at the end of the day here. So they were higher than where they opened, but they did go as high as this number here, but they couldn't close there, so they closed here. So when it's green, that means the market was up for that day. When it's red, the market was down that day. What these wicks, they tell us, the tails, they tell us there was some pressure, there was an attraction, the buyers were in, but the sellers pushed them down. So just watch them as if like somebody's pushing down and creating these tails. So this is what happened the next few days. So I put a little box in here. You can see how many times we've had these tails. Last week, I mean, granted we were down 2.3 or 2.7, depending on the markets. But when we look at the S&P, this is the futures, you see there's these big wide ranges. I mean, look at that. And there are huge ranges. So there's a lot of volatility and some indecision. So this right here told me that something is happening. The sellers are still in control. And that's what my bias, again, your job is to make sure you have the probability and odds in your favor. if you were thinking of, for instance, you thought about doing a covered call, you were thinking of selling, basically doing some selling calls, by watching this, this might have given you a good idea. Okay, the resistance, every time we hit this number here, we had the sellers come in. So that's why I say the markets do give you clues, and that's what I want to take advantage of that. Let's go to the trade of the week. And with the trade of the week, I want to talk about a couple. One is more of a psychological trade for me. The other one was about what happened. In this scenario, I just chose one of it. It's a futures market. I did at 6:30 and 10 seconds or 20 seconds. I sold an S&P contract and I covered here. I had few. And I kept doing this every day, but I tell you what was my logic, and this gives you a little better understanding of, it was at 6:30 something, and this is where I covered. Why did I do this? What was my reasoning? And I kept repeating this for the next few days. The thing is, this is again the futures market, but you can apply that with SPY ETF. We talked about gaps, and gaps, what happens, these are the times that overseas, like after hours, there have been activities, there have been buying and selling. And then when the markets open in New York, you're at 9:30 their time or 6:30 our time, there is a big pressure. And what happens, because of this selling pressure or buying pressure from the previous day from the overseas market, the markets open up, and that's where the gap up is. So in this situation, we had this big gap here. And this was actually last Friday. Then we come, and then we actually had the gap on Monday, which was very small. I couldn't really draw. There was a gap there. Tuesday, we had this gap up. Wednesday, we had gap up. We had a small gap on Thursday, and we had a big gap. We had another gap on Friday. So if you understand the gaps in the futures market, and we will go in depth once, I will be doing some videos, and I will go much in depth when it works the best, what days, as far as what markets it is the best to use, and also what part of the month is very much accessible, and as far as application wise. So majority of, I'll give you one hint, majority of these gaps, number one, they 82% of the time, they close half of that gap. You do have professional gaps, but if you notice, not only we closed the half of gap on that Friday, and then we had it on Monday, and then Tuesday I did the trade. You could notice that we actually closed half of it, and then by end of the day, we almost closed all of it. Except I noticed that when we had on the down days, and it happened twice, it happened on Wednesday and Friday, we did not have the power to go back and close that half a gap. The same thing happened on Friday. What that told me that there was this institutional selling, and this was real. I also used ticks that we will discuss it later. When we had Thursday, we had a small gap down. We did close it, so that worked. But these two big days, they didn't. So that was another hint. So my trading was based on, again, the filling the gap, half a gap, these 82%, and depending on day of the week, it goes from 62 to 68%. You get a full gap, and this again, you can play this with options on spiders maybe if you like, but also it just gives you the guidelines to read the tea leaves. Now here we have as an island really, what has happened. We had a gap up and we had a gap down, even though we filled part of it. It gives you a warning sign on Wednesday what happened. So that was the reason I did my futures trade, basically on all these gaps. And my bias was mostly to the downside. I also have a gold trade that I usually do, and this was one of them. On Thursday, I bought the GLD options, and as you know, the markets actually were, everything was being selling off. But I put my targets when I buy my, and I got covered. Again, I put my limits, and I always like to have a one runner, and then it was really getting close to the closing, and I didn't want to being in the money. That meant if I am, now this was 165.5, and the gold actually went to 166.5 or 166.6 or so. I didn't want to be assigned, so I waited and waited and finally toward the end. Obviously, it was a little premature because it did go up, but you know, I covered. I just didn't want to have, you know, come on Monday showing that it was for one contract I would have been assigned 100 shares of GLD. So basically, that was one trade. Again, leaving your limits, the targets. Make sure you're protected, but also know where you're going to get out. The other part was this Friday morning when we had that big sell-off, I decided to add more to my gold option, and I felt it was low enough, so I bought some, and you know, it did have a good, you know, I think I was up 50-60% on it, so I sold out. Now, the reason I want to show you this is I could have made a lot more. It could have gone up, you know, when I sold it was sometime around 60 cents, 55 to 60, and it went all the way to 150. I have no regrets. Number one, unfortunately, you know, I don't trade a lot between 9 and 11. I said it. I had an appointment. I had to go somewhere, and I just didn't want to leave this. This is just a small trade I want to. So I left it alone, and I was already out of it by the time I left. So basically, I missed a big chunk of that. But my discipline was there. I knew what I'm going to get out. It's wonderful that it could go up all the way. Probably I would have been assigned if I left some, who knows, or I would have been a happy person, paid for a nice meal for the week. But the question is, you do not look back and regret your decisions. Stick with your discipline, what you're supposed to do. This is a specific strategy that I use on Thursdays, and I stick with that strategy. I thought to, every week we'd like to have something, either website or ETF or ETN of the week. And this week I thought, let's talk about FNGU, which is the triple FANG stocks. This ETN came out, let's say about a couple of years ago. And what it does, it follows only 10 holdings. And I'll come back to this chart. The 10 holdings, and they were equal 10% on each. So you have NVIDIA, Baidu, Amazon, Netflix, Baba, Google, Facebook, Apple, Tesla, and Twitter. And these are the leaders, and you know, as you can see, we have Apple, Facebook, Google, Netflix, Amazon, and the FANG stocks, really. So that's where the name comes. Now, this is the 3 times. So basically, like what you see, this is the FANG, and by watching this, again, you can get a better indication of what the markets are going to do, because you have Apples and Googles and Amazons of the world. Now, because this is 3 times and it's the ETN. ETN, there's a difference between ETF and ETN. ETF is an exchange traded fund, which is a basket of stocks that actively being bought and sold, and they have to follow the index. Exchange traded note, you really don't have active buying and selling. You are at the mercy of the issuing bank in a good faith So it's actually a note. So whatever the index of these, the 10 stocks, let's say, did, they copied at the end. Now, the negative thing about this is that obviously you have that the fate of the bank. Barclays had a problem a few years ago, if you recall. So, and that's why we had a big movement. It was Singapore Fund and a few other exchange traded, notes actually got affected because Barclays had problem. So you really are at the mercy of the whatever the bank is issuing the notes. The positive thing is because they don't have to be actively in and out, they don't have to do the rebalancing in a sense real. And so the management fee or expense ratio is lower. Now you can see on Friday what happened was $11.62 down because again, they're the triple. So for your information, if you want to be want to follow these FANG stocks, for instance, I just thought these are, you can use, this is the one time, not much volume, though FANGO is a double. FANGO is the most liquid. So these can be maybe a day trading instrument if you like to play. And then we have the inverse that they go, if they make money when the FANG stocks go down. So it's more of a hedge play. So just a little more a tool for your trading strategies. Also ICE and in New York Stock Exchange, there is an index. There's 6 indexes, but this is the most liquid one. If you ever wanted to add this to your itinerary, this goes 1-to-1, and you can see again, this is the actual index. So you cannot buy and sell this, but you can use it as a reference point. Now, these are the short term. I use a 3/8, and this is a 21-day moving average is exponential, and you can see there was a heavy pressure. Obviously, Facebook played a big role on that, but this is what's happening with the index. So if you'd like to see what is happening with the markets, as far as the big horsemen of the markets, you can follow this. And again, I would follow what's happening with the stochastics. So talking about exchange traded notes, I thought this is something happened. Some of you, if you were in the market in February of 2018, it works until it doesn't work. The death of XIV shows the folly of gaming market volatility. And what that means is XIV was a huge ETN, which basically worked opposite of the volatility. Or we have VXX, for instance, you follow. VXS follows what the volatility is. XIV was opposite, and it was doing fantastic. I mean, the markets will go up, and this will go multiple times up because obviously the volatility was crushed. So the lower the volatility, the higher the XIV. Till this was a Credit Suisse ETN. One day on February 6th, right before that day, it collapsed. It lost 90% of its value. A lot of people had used XIV as a big investment tool, and they were protecting maybe their volatility risk. And what happened was the volatility in the sense that if they own VXX, they want to have something like this. So when the market went up, they were doing really good. And it affected the markets very much. And this news came on June 22nd. Credit Suisse again announces that they're going to delist quite a few of their ETNs. So they have the 3 times the UGLD, USLV. There are a lot of, these are, as you can see, there are a lot of inverse and leveraged instruments. And you probably are familiar with the TVIX, the USLV, UGLD. UGLD, this is a DGLD, the inverse. So I'm just giving you a heads up. So times like this, when it happens, it adds to the volatility of the markets. The reason I show this happened on Monday. And this is a chart from 2018 when the news came out. about the XIV, and this is what happened that week. So I follow the history. I like to see it. This was a lot bigger news. Now, with all the other volatility, sometimes it kind of helps us to understand it. A lot of other things have happened, so it doesn't have the exact same effect that in 2018 had it. It was the first time. It really shocked everyone in a sense that seeing that, how could an ETN go out and be delisted? But it happened. So we are going through the same thing. Now, I did own UGLD. So they asked me what I should do. Well, basically on Friday, because they're going to be delisted on July 2nd, and well, the official will be July 11th. So basically they are, or July 10th. So they are, I just didn't want to take a chance. I just got out of it and I had a nice ride. So I've been out of it a few times. I just sold my last one. So again, these are the information that you want to have. You're going to make sure whatever holdings you have, make sure you follow to see exactly where they stand. So you don't want to just, we follow the markets, but also each one of them have their own internal information. So the last but not least, what I thought we will talk about this last week we did, the S&P's expected move. Again, this is another indicator that you have access to. These are the option makers use this to price all the securities, not just S&P, 500, but also from Apple of the world to gold. And last week, the expectation was 112.76. We had, I think 4 or 5 days, we had a 100-point move in the market. So it was a pretty volatile week last week. For this week, we have the expected move is 101. And remember, there's only 4 days. So what will happen is they feel by Thursday, S&P would move up or down 101 points. And it's interesting, this is the first time, I don't know, in a long time, we have 4 days of, every day there's a S&P option expiration. So you do have, like Mondays, Wednesdays, Fridays, there's an option expiration for S&P, which you can play for very short term. Tuesday is the quarterly expiration. And Thursday, because there's no Friday expiration due to holiday, as you know, the 4th of July holiday is falling on Saturday, but Friday it's going to be closed. So Thursday, so we have Monday, Tuesday, Wednesday, Thursday. So every day you can play options on S&P. And the volatility is tremendous. I mean, just for Monday, the market movement is priced at $50. So that means it will go up 50 or down 50 points. It's interesting this week, we got a lot of news. Thursday is going to be a huge day because of the couple of employment numbers. One will be unemployment, but also remember the first Friday of the week, of the month, the employment numbers come. So obviously everybody's going to be following that carefully. So that's happening on Thursday. And then we have the Fed is on Wednesday. We'll see next week. We'll see what they have to say. So basically, there's the day before 4th of July. On the other hand, Monday and Tuesday we'll have the option, but then Wednesday, which is the first day of the month of July, a lot of again 401k money comes into and a lot of retirement money. So usually there's a little positive bias that day, but then a lot of other information going on. We haven't seen anything like this. I don't recall. I mean, 2008 was the last time I had seen this. We had the pigs, in Europe with the Greece situation and other things, but nothing like this. I mean, we are really event driven, and on top of all that, it's election year. I mean, that's another volatility added that, last week, with Biden taking a big lead over President Trump. And this is what's happening. The vice president is really getting momentum. So the markets are watching all this. And there's not just one level. I mean, when you have Europe not allowing Americans to fly, what that tells you is something, that there's a lot of concerns out there. So be in the markets, be careful with it, manage your trades, and have a great, profitable, and healthy week ahead. So with that in mind, I'm gonna close out this week. So I want to finish a little earlier because I want to talk to each one of you, and then we'll have Q&A. So Sean, I'm at your service, and can maybe stop recording.
Okay.
Thank you.